You need to understand what just happened, because most people are still looking at the charts, but not seeing the signal. Only a few months ago, Bitcoin was trading above $120,000, and the atmosphere in the market felt unstoppable. Headlines were full of optimism, liquidity was flowing, and speculative momentum pushed prices higher at a speed that reminded many of late-cycle surges in past financial bubbles. But then the reversal came, and it came fast. Prices began to fall, first slowly, then with growing urgency, until the market found itself trading tens of thousands of dollars lower. To the casual observer, it looked like just another correction. But to those who have studied cycles for years, the pattern felt different. If you look carefully, the first signals were not visible in price alone. They appeared in liquidity conditions, in funding rates, in derivatives positioning, and in the subtle tightening of global financial conditions. When central banks maintain higher interest rates for longer than markets expect, speculative capital becomes fragile. This is not new. We saw similar dynamics during the tightening cycles of the late 1990s, and again in the period leading into the 2008 crisis, when leverage began to unwind quietly before the public fully understood what was happening. Capital does not disappear overnight. It retreats step by step, and each step leaves a trace. The real causes behind this volatility are deeper than headlines suggest. Bitcoin does not move in isolation. It reacts to the same forces that shape all macro assets: liquidity, risk appetite, currency strength, and the cost of capital. When government bond yields remain elevated and the dollar strengthens, global liquidity tightens. Emerging markets feel the pressure first, then speculative assets begin to weaken, and eventually even the strongest narratives face gravity. This is the rhythm of financial history. It is the same rhythm that shaped the dot-com unwind, the commodities collapse of 2014, and the tightening cycles that forced entire sectors to reset. What makes this moment different is that the signal is now global. Institutional investors, sovereign funds, and macro desks are all watching the same indicators. Conferences, policy discussions, and industry gatherings are no longer talking only about growth and adoption. They are talking about stability, regulation, and survivability. That shift in language is not cosmetic. It is a sign that the market is transitioning from euphoria to evaluation, from expansion to consolidation. Every major financial transformation in history has passed through this phase. Whether it was the early years of the internet, the expansion of derivatives markets, or the emergence of gold as a global reserve asset in the 20th century. And yet here lies the contradiction that few are willing to address openly. Even as volatility increases and prices retreat from their highs, interest in Bitcoin has not disappeared. Infrastructure continues to develop, regulatory frameworks continue to evolve, and institutional research coverage is expanding rather than shrinking. Normally, when an asset falls sharply, attention fades. But in this case, attention is intensifying. That is not the behavior of a dying market. It is the behavior of a system undergoing stress and transformation at the same time. So, you have to ask yourself what this really means. Not in terms of tomorrow's price, not in terms of quick predictions, but in terms of structural change. Markets are not just numbers on a screen. They are reflections of human confidence, political power, and economic reality. When an asset like Bitcoin moves this violently while remaining at the center of global financial discussion, it is telling us something important. It is telling us that the game is no longer purely about speculation. It is about positioning, influence, and the gradual reshaping of the monetary landscape. And what we are witnessing now may not be the end of a cycle, but the beginning of a much larger transition that is only starting to reveal itself. You need to look beyond the price chart for a moment, because what is happening beneath the surface is often far more important than what appears on the screen. While most people were focused on volatility and daily movements, a quieter but far more revealing signal began to emerge inside the Bitcoin network itself. Mining difficulty, which normally trends upward over long periods, suddenly dropped in one of the largest adjustments seen in years. That kind of move does not happen without pressure, and it does not happen without consequences. To understand what this means, you have to understand how mining functions in the broader financial system. Mining is not just a technical process, it is an industrial operation tied directly to energy prices, interest rates, and capital costs. When the price of electricity rises, when borrowing becomes expensive, and when liquidity tightens, weaker operators begin to disappear. This is not speculation. It is a structural reset. We have seen similar patterns before in other industries. During the oil market collapse of 2014, high-cost producers were forced out, and production consolidated among the strongest players. The same pattern appeared in the steel industry in the early 2000s and even in the banking sector after the financial crisis of 2008, when only the most resilient institutions survived the tightening cycle. What you are witnessing now follows that same logic. When mining difficulty drops, it often signals capitulation. It means some participants have reached the point where operating costs exceed revenue, forcing them to shut down equipment or liquidate reserves. And when miners liquidate reserves, it creates additional selling pressure in the short term, which feeds volatility and reinforces fear in the market. This cycle can look chaotic from the outside, but to someone who has studied financial systems for decades, it has a familiar structure. It is the process of cleansing excess leverage and inefficient capital allocation. But here is the part most people miss. Every major reset in financial history has created the conditions for the next phase of stability. After the railroad bankruptcies of the late 19th century, the industry emerged stronger and more consolidated. After the dot-com collapse, the surviving companies became the foundations of the modern digital economy. Stress in complex systems often precedes resilience. That is a law of markets as old as markets themselves. Now, consider the global context in which this is happening. Energy prices remain volatile in many regions. Interest rates, while no longer rising as aggressively as before, are still elevated compared to the ultra-cheap money era that fueled much of the previous expansion. Capital is no longer free, and when capital is not free, inefficiency becomes visible very quickly. This is not just a Bitcoin story. It is a macro story. It is about the cost of capital in a world that is adjusting after more than a decade of extraordinary monetary stimulus. And yet there is a contradiction here that you should not ignore. Even as weaker miners exit and difficulty adjusts downward, the network itself continues to function. Blocks continue to be produced, transactions continue to clear, and the system continues to adapt. In traditional finance, when stress reaches a certain level, institutions can fail in ways that threaten the entire system. But decentralized networks behave differently. They contract, they rebalance, and they continue. So, what does this tell you? It tells you that the signal is not one of collapse, but of transition. Markets are sending a message, and that message is not written in headlines or social media reactions. It is written in structural data, in industrial behavior, and in the quiet retreat of the weakest participants. And if you have spent enough years watching financial cycles, you begin to recognize that moment, the moment when panic headlines dominate the conversation. But the underlying system is not breaking, only reshaping itself. That is often the moment when history quietly changes direction, even before most people realize that it has already begun. You need to pay very close attention now, because what is happening is no longer only about markets, charts, or mining operations. The real battlefield is shifting toward policy, regulation, and control. And this is where the deeper forces begin to reveal themselves. While investors argue about short-term price movements, governments and central banks are quietly moving pieces on a much larger board. And if you have followed financial history long enough, you know that whenever policy begins to move, markets eventually follow. In recent months, regulatory discussions around digital assets have accelerated. Frameworks for stablecoins, custody rules, reporting requirements, and oversight mechanisms are being shaped at a pace we have not seen before. This is not random. It is a predictable reaction whenever a financial system begins to grow large enough to matter. The same thing happened with the euro-dollar market in the 1960s, when offshore dollar liquidity began to expand beyond the direct control of the Federal Reserve. At first, authorities underestimated it, then they studied it, then they moved to regulate and integrate it. The pattern repeats itself again and again across decades. You have to understand the psychology behind this. Central banks are institutions built on the principle of monetary stability and control. Their primary tools, interest rates, reserve requirements, and balance sheet operations, are designed for systems where money flows through regulated channels. Bitcoin and other decentralized assets introduce something unfamiliar, a parallel monetary infrastructure that does not respond to traditional levers. That does not mean central banks are powerless, but it does mean the environment becomes more complex, and complexity makes policymakers cautious. And this is where the contradiction becomes visible. On one hand, some policymakers and political leaders publicly support innovation in digital assets, speaking about competitiveness, technological leadership, and financial modernization. On the other hand, regulatory bodies continue to tighten oversight, impose reporting standards, and emphasize risk management. Support and restriction are happening at the same time. If that sounds contradictory, it is because it is. But history shows this is exactly how new financial technologies are absorbed into the system. Think back to the early days of the internet. Governments encouraged expansion, but also imposed regulations on telecommunications, data protection, and financial transactions. Or consider the development of derivatives markets in the 1980s and 1990s. At first, they grew rapidly in a relatively open environment. Then, after periods of instability, regulation intensified, transparency increased, and the markets matured. What begins as a frontier eventually becomes infrastructure, but the transition is never smooth. Now, look at the global stage. Discussions about digital currencies are no longer limited to private assets. Central bank digital currencies are being researched and tested in multiple regions. Payment systems are being modernized. Cross-border settlement mechanisms are being re-examined. These developments are not isolated events. They are part of a broader transformation in how money moves across the world. And when the architecture of money begins to change, every asset connected to that system feels the impact. So, what does all of this mean for the moment we are living through right now? It means that Bitcoin is no longer operating in the shadows of the financial system. It is operating in its spotlight. Every regulatory speech, every policy paper, every congressional hearing, every central bank report adds another layer of attention. And attention, in finance, is power. Assets that are ignored can disappear quietly. Assets that are constantly debated, analyzed, and regulated rarely vanish. They evolve. You should understand something important here. The struggle that is unfolding is not a simple battle between one asset and one institution. It is a slow negotiation between two different philosophies of money, one built on centralized authority and one built on decentralized networks. That negotiation will not be decided in a single year or a single election cycle or a single market correction. It will unfold gradually through policy decisions, technological development, and the shifting preference of millions of participants across the world. And as you watch events unfold, remember this. Financial history is shaped not only by prices, but by power. The most important changes often happen quietly, in policy meetings, regulatory drafts, and institutional strategies, long before they appear in headlines. What you're seeing now is not just volatility or uncertainty. You are witnessing the early stages of a transformation in the relationship between governments, central banks, and digital money. And once that transformation begins, it rarely reverses. It only accelerates. You need to step back for a moment and look at the bigger picture, because what is happening now is no longer just a story about a volatile asset or a regulatory debate. What we are witnessing is the early formation of a new monetary narrative, and these moments in history are rare. They do not announce themselves loudly at first. They begin quietly, almost invisibly, while most people are still focused on short-term movements and daily headlines. For decades, the global financial system has operated on a structure built after the Second World War and reinforced after the collapse of Bretton Woods. Central banks became the anchors of monetary stability. Sovereign debt markets became the foundation of global liquidity, and reserve currencies became the backbone of international trade. This system has proven resilient, but it has also accumulated enormous imbalances, record levels of sovereign debt, persistent deficits, and repeated cycles of monetary expansion followed by tightening. Every time a crisis appeared, the response was larger stimulus, larger balance sheets, and deeper intervention. That pattern worked, but it also changed the expectations of markets and governments alike. Now, we are entering a different phase. Interest rates are no longer near zero. Inflation, even when moderating, has reminded policymakers and investors that currency stability cannot be taken for granted. Governments are facing the reality of refinancing trillions in debt in a higher rate environment. These pressures do not cause immediate collapse, but they slowly reshape incentives. And when incentives change, capital begins to search for alternatives, sometimes quietly, sometimes suddenly. This is where Bitcoin begins to occupy a different place in the conversation, not as a speculative curiosity, not as a fringe experiment, but as one of several emerging instruments in a world that is searching for new forms of financial architecture. You can see the shift in how institutions speak about digital assets, in how research departments analyze them alongside commodities and currencies, and in how geopolitical discussions increasingly include references to digital payment networks and cross-border settlement alternatives. When an asset begins to be discussed in the same breath as strategic reserves, you know the narrative is changing. But there is another contradiction that you should recognize. Even as this new narrative forms, volatility remains high, skepticism remains strong, and uncertainty remains everywhere. That is normal. Every transformative technology or financial instrument passes through a phase where its long-term significance grows even while its short-term behavior appears unstable. Railroads in the 19th century were volatile. Oil markets in the early 20th century were chaotic. The internet in the late 1990s experienced dramatic collapses before becoming the foundation of modern commerce. Instability does not always mean weakness. Sometimes it is simply the cost of transition. And there is something else happening beneath the surface that few people fully appreciate. The world is becoming more multipolar, not only politically but financially. Trade patterns are shifting, payment systems are diversifying, and countries are increasingly interested in reducing dependence on any single monetary channel. In such an environment, alternative stores of value and alternative settlement mechanisms naturally attract attention. This is not ideology, it is strategic behavior. Nations, institutions, and investors all respond to incentives, and the incentives are changing. So, what does this mean as you stand here watching these events unfold in real time? It means you are living through a period where the definition of money itself is being debated, redesigned, and tested. That process will not be smooth. It will involve cycles of optimism and fear, breakthroughs and setbacks, regulation and resistance. But once a system begins to evolve at this scale, it rarely returns to its previous form. And this is the conclusion you should carry with you. The volatility you see today is not just noise. The regulatory debates you hear are not just politics. The mining resets, the institutional discussions, the shifting global narratives, all of these are pieces of a larger transformation. The game is not changing in a single dramatic moment. It is changing slowly, layer by layer, decision by decision, year by year. And the people who understand this are not the ones reacting to every daily movement, but the ones who recognize the pattern that history has shown us again and again. When the foundations of money begin to move, the consequences are never small, and the world that emerges afterward is never quite the same as the one that came before.